Welcome to the Family Cabins and Vacation Homes. I'm Jim Cunningham. I'm here with Connor Clemens, and we're going to cover some very important information about Proposition 19 and how it changes everything when it comes to property taxes and the vacation home. We do have a question out of the gate. Will this cover rental properties or just the second homes? A lot of our discussion will cover rental properties. It's the same issue. There are more issues when it comes to vacation homes and cabins, frankly, than rental properties. So a little bit more complex dynamics on the estate planning side, but this certainly does apply. And so thank you, Dale, for asking that question. So Connor Clemens is an associate attorney at our firm, Cunningham Legal. He has been presenting with me on Prop 19. We've done several videos on this. So if you see this and you say, gee, I'd like more information, or I'd like to take a deeper dive, go ahead and check out our other videos on YouTube. Very important. This is a disclaimer. Connor, do you want to tell them about what a disclaimer is?
Yep. So everything we talk about today is purely for educational purposes only. It is not legal advice. Even though Jim and I are both lawyers, we haven't seen your unique situation. So we can't really apply the law to your situation. And so everything we talk about, totally for educational purposes only.
And we have 7 attorneys in our firm. That's me. Connor's kind of in the middle. Tasha John, Rochelle Lee Warner, Liz Seitz, Jeff Rosen, and Janice Lee Shen. Each of these lawyers practices in the trusts and estates arena. Prop 19 is within that area of law that is trusts and estates, and that's typically handled by estate planning attorneys. And so we're experts in the field. Many, if not all of us, are certified specialists or have an advanced degree in estate planning. So the family cabin and vacation home, here is how Prop 19 changes everything for your family. So today we're going to talk about Prop 19. We're then also going to put that in the context of the family home. And Connor, you want to give them the spoiler?
The big spoiler is jumping ahead. Of all these different houses to potentially transfer to your children, the one you live in, the one you rent out, the one you vacation in, it's the vacation home that oftentimes makes more sense. And I think today you're going to understand why that is the case.
So let's talk about Prop 19. So what just happened? Believe it or not, it is now the first day of December, and they still have not counted all the ballots. So 99% of precincts are reporting. This has been kind of consistent for the past couple of weeks. Prop 19 squeaked by with 51.1% voting yes and 48.9% voting no. Those are your two choices, yes or no. And what is interesting is Prop 19 is not Prop 15. And we were really focused as lawyers, and a lot of our clients, frankly, were focused on Prop 15. Prop 15 was reassessing commercial and industrial property. So that's the one people really got fired up about. That one, the yeses got about 48 or 49%, Connor, didn't they? It was very close.
Yeah, close.
So if you own commercial or industrial properties, this ain't over, right? Because this can come up again. And so I would just be vigilant on that and watch it. But here's what Prop 19 did. Prop 19 repealed a very powerful tax tool that we have in our arsenal as estate planning attorneys. It repealed Proposition 58. And do you want to explain what these 3 propositions are, Connor?
Yeah, of course. So I guess we'll start from the beginning. Proposition 13, which is a law that's famous throughout the entire country. Throughout most of the country, property tax is based on the fair market value of the property. And that included in California back before 1978. But if you were alive in 1978, or if you know history, 2 things happened at that time. 1, the value of real estate shot up in California. And 2, there was inflation at a quick pace. So California voters collectively got together and passed Proposition 13 that made property tax assessments based on acquisition value plus inflation. So basically what happened was the longer you own property in California, the more favorable your property tax rate became.
Yeah, so here's an example. This is a home in Carlsbad, a nice beach community. Mom and dad buy this vacation home in Carlsbad for $50,000 in the 70s. Which, by the way, now, Connor, you would look at that and go, well, that's kind of a cool beach home, $50,000. That's not much money. In the 1970s, $50,000 was a lot of money. Okay. This was not a small amount of money. This was a lot of money to spend on a property. Now the property's worth $1.5 million. The property's assessed at $118,000. Now, how is that even possible? It's because that $50,000 assessment only goes up in accordance with the California Consumer Price Index with a maximum cap of 2% a year. And so this 50,000, 2% a year, it's 118,000, but the property's worth $1.5 million. So the taxes are just under $1,500. Folks, this is Prop 13, and this is why Prop 13 is a very important, very valuable property right. And then in the 1980s, Prop 58 lets the kids keep the parents' Prop 13 taxes, and the kids' kids keep those taxes too. So this goes from one generation to the next. And that is this beautiful combination of Prop 13 and Prop 58. It's where families who own property for a long time in California can benefit from Prop 13. But what if mom and dad were to sell the property? Okay, so what happens if mom and dad sell the property in 2020? Another couple this lovely couple here buys the house. Their property taxes go to almost $20,000 a year. It's because whenever there is a change in ownership, property is reassessed at its fair market value. And so if the fair market value is $1,550,000, the property is reassessed and the taxes are 1% plus some added taxes on a county by county basis. And so that's your difference. That is a lot of money. That's a big difference every year. And so you want to talk about the current property tax structure, give a recap. You need to hear this 2 or 3 times to really get it.
Yeah, so property is assessed at 1% of market value when the change of ownership occurs. So you buy your house for $700,000. What is that? $7,000 a year.
Mhm.
And it's going to go up every single year by at most 2%. That's supposed to be the inflation. Now, I know there are people out there who say, hey, I pay more than 1% on my property acquisition value. And that might be the case because you're paying for all those different fees that your city might have passed or your part of the county might have passed. And as I said before, really the people who own the property the longest in California are the people who really reap this benefit. Now, one day, if you bought your property recently, inflation occurs, price of real estate goes up, you will benefit from it.
Mhm.
But I mean, that's been really the course of history in California. The longer you own the property, the better your property taxes are.
Yeah, and so their property is reassessed when there is a change in ownership. And I hate to sound like a broken record. This is a very important concept. Whenever a property changes hands, it's a change in ownership unless an exemption applies, okay? So parents currently, this is under Prop 13, this expires February 16th of 2021. Currently, the parents can leave a home of any value to their children, one child or more than one child, of any value, no reassessment. So if the parents bought a place for $500,000 in the 70s in Pacific Heights in San Francisco that's worth $20 million, which is not uncommon, the kids can inherit that property. The parents can give that property to the children, and the children take the low Prop 13 taxes. So their taxes are probably $6,500, $7,500 a year instead of $250,000 a year. So it's a really big, really important property tax benefit. Obviously, an extreme example. Now, there is a cap on this. So it's unlimited on the house, but anything other than your primary residence, which is that when you check that box, the $7,000 homeowner's exemption, each parent can leave $1 million each in assessed value. So if you have 2 parents, they can leave 1 million each. And I suppose theoretically, Connor, if the parents were divorced and remarried, it could be 4 million. Theoretically, that's if your evil stepmom is going to give you $1 million in property. I don't think that's going to happen. Joan has a question, or Juan, however it's pronounced. So, my husband and I, so this would be Joan. My husband and I have a second home that we live in 50% each week. Can a wife and a husband each have a different primary residence? I don't know. I don't know the answer to that question. I'm assuming yes. It may be tied to your filing status in California if you file jointly or file separately. That's a great question. I just do not know off the top of my head, but that is one hack that we're kind of working on. We're kind of doing a lot of research and development right now in figuring out the best structures so that we can trigger a change in ownership.
I mean, let me tack on. We've actually talked about that before. Can you have 2 different primary residences? I mean, we kind of think you can, but that's a hard test to satisfy because you have to have the 2 spouses spending a significant amount of time apart. So I think I might have an appointment with Joan coming up. So I'll be sure to think about
Okay.
that before the appointment.
So Proposition 19 is effective February. A lot of Prop 19 is effective February 16th. What we're talking about here, parent to child changes in ownership. There are other parts that are effective April 1 of 2021. So a little bit different effective dates. Again, it passed 51 to 49. It repealed Prop 58. So let's talk about vacation homes and family cabins. Something you need to understand is Prop 19 guts Prop 13 for vacation homes, okay, and rentals. All right. So if it's other than the primary residence of the parent, then all of these rules apply. The parent to child, there is a parent to grandchild transfer exemption. We don't see that too often because the grandchild's parents have to both be deceased. So, fortunately, we don't see it that often. But the parent to child transfers are eliminated, but there's a very narrow exception on the primary residence that we'll cover. All other types of real estate are reassessed at their fair market value, and this includes the vacation home or the family cabin. Now, a lot of our clients have that home in Carlsbad that they paid not a lot of money for. Maybe they inherited it from their parents or grandparents. And many people simply just cannot afford to pay the new assessed value. A lot of these homes, a vacation home, it takes a lot of money to keep that going, and many of these aren't rented, so it's kind of an expense item for the family. And then to heap on reassessment can make it where these homes, just frankly, people will sell them when the parent passes away. So something to understand is Prop 19 means that when the kids inherit the property will be reassessed at its current fair market value. So in this case, mom and dad die. If they don't do any planning, this death is considered a change in ownership under California law. So when a person passes away, that is a change in ownership. In this case, mom and dad die, it triggers a change in ownership. So now the property gets reassessed. The property taxes are increased by $18,000 a year. And then the question is, will the kids be able to keep the property? And another one we're going to cover in a couple of slides, who pays for it? Right? What if one kid lives in California and the other one lives in Michigan, and the California one's like, yeah, let's keep this. And oh, by the way, Michigan sibling, you got to kick in money every year. How's that going to work? Right? So these are some issues that we're talking about with clients. Any thoughts on that, Connor?
No, I mean, that's exactly it. I think it's important to think about this type of stuff even before Prop 19, before parents die. A lot of my clients think about it because that's when things get undone, is when kids start changing properties after death. There's no undoing this type of stuff with Prop 13.
I mean, and these are issues that really need to be, and these are really, I think, unique to the family vacation home. And this is why we're kind of doing a carve out on the Prop 19 webinar for this, because these typically are not income producing properties. They're properties that have expenses associated with them, and they're personal use properties. But paying for upkeep is a big deal. That is not a small line item. Many of the vacation properties are in areas that require higher maintenance. So if you've got a cabin, that implies, snow, woods, you've got some maintenance issues there. Certainly if you're on the coast, for those of you who live on the coast, those homes typically require a heightened level of maintenance. And who can use the property and when? I mean, you got to work that out, right? Maybe the property's not big enough for everyone just to show up whenever they want. And so, that's a discussion item. And again, who uses the property? In-state, out-of-state people. Some people might use the property more than others. And then what if a sibling wants to be bought out? So 3 kids inherit the property. How can a sibling buy out another sibling without triggering reassessment? It is possible. It may take a number of years to accomplish that and avoid reassessment. It may not take a number of years. It just depends. It's a case-by-case analysis. So what are best practices on the family vacation home, beach home? You really do need to get buy-in from your kids. And we when we do estate planning for clients, we set up these estate plans. We go over them with the client, the parents in this case. Many times the parents never talk to the kids. And I'm not suggesting that if you've done an estate plan, you immediately dart out and tell your kids everything that's in there, because right, the kids you may not want to tell them. It could cause some conflict in the family. But on this one, I think some mindfulness about kind of testing the waters and checking in with the kids, like, hey, do you guys really want this when we're gone? I know that there is a lot of emotion attached to property for many people. And then when that person passes away, in many cases, that emotional attachment diminishes. Maybe it goes away entirely, or maybe it doesn't. So this is just kind of a conversation you need to have with essentially the stakeholders, the kids, the ones who are going to have to live with this. And then I would also gauge the interest in ownership. A lot of kids love to go to Carlsbad and hang out and go surfing and, get out of the cold winter, but they may not want to own it, right? When it comes to actually forking over money to maintain the property, that could be a different story. So I think it's something you want to talk to your kids about. And then you need to examine the financial aspects from every angle, not from every angle, but from every angle, and really kind of take a realistic view. Like, what is the cost associated with maintaining this property? Where's the money going to come from? And you need to work through those issues. So Greg has a question. Can you transfer the home to minor children 14 years of age before the effective date of this proposition? Yes, you can. We're kind of in the R&D stage, for lack of a better term, of our Prop 19 planning. We are accepting new clients, and clients are retaining us, and we're working through. This is, I will say, as a lawyer, this is a very difficult undertaking. And I've been in multiple study groups across the state, talking to some of the smartest lawyers in the state of California. The nature of the change in this law, it basically requires a complete rewiring of your lawyer brain to approach this in a completely new manner, in a manner that we've never approached before. So, an outright distribution, we'll talk about that, whether that makes sense or not. That's a little bit easy. But if you have a 14-year-old and you want to transfer the property, or maybe you have a son or a daughter and you're not sure if they're, how solid their marriage is or whatever, right? Use of a trust can be a very powerful tool. And we are working through the research and development stage. I know I've been thinking about this bill passed, this initiative passed a couple of weeks ago. I've basically been thinking about this nonstop for 14 days, and a few other attorneys I've been talking to have been thinking about this nonstop. And so we're developing a plan. It's not quite fully baked, but we're almost there. Jay asks, can a parent sell the vacation house to the adult child at the currently assessed value rather than the market value and keep the current property tax level? Yes. So a parent to child transfer does include a sale. So you could sell it. If you sell it for less than fair market value, the difference will be a taxable gift, right? Now, whether tax is paid or not, but it is a taxable gift. So a sale is certainly appropriate.
If you sell it, period, and you have gain, you're going to pay the capital gains. So
Yeah.
we're going to talk about these issues as we go through this webinar today.
And there's some more advanced techniques where you can sell the property to the children and not realize a gain. So that's some more advanced techniques. Anonymous attendee asks, my parents have 2 income apartment rentals and a main home. Father passed away 2 years ago. Mother is ill and under a caregiver guidance. Is there anything we can do as trustees to protect the reassessment of property value when our mother passes? I believe so, but you're going to need to do a lot of that before February 16th. And so go to our website, set up a time to speak with us. We are offering 1-hour consults for $500. So you go to and we'll give you instructions at the end on how to do that. But you go to our website, you sign up for an appointment, and then someone will contact you to schedule a time. We do need a copy of the estate plan, and we do need your property tax bills and also some general data about you and your family. So you want to talk about how Prop 13 works now, Connor, until February 15th?
Until February 15th. So, I mean, generally speaking, if you have a primary residence, even if it's worth $10 million or $100 million, whatever your property taxes are, you can pass to your children. That's on a primary residence that you live in. Doesn't matter if your kids live there, but on your additional properties, whether it be a vacation home or a rental property, each parent has $1 million of assessed value they can pass to their kids. Total. So assessed value, not fair market value. So I have a lot of clients who bought their property a long time ago. They can pass over a lot of their properties to their kids and not have the kids get reassessed. But like someone who bought their property recently, they can't do as much. So we'll go through an example here. This is a pre-February 15th example. So we have mom and dad. They buy a beautiful La Quinta home in 1990 for $100,000. I always think La Quinta is a great value play in California, which is hard to find. And now it's worth $700,000. So your assessed value is $200,000. So the parents pay him like $2,500 a year in property tax, and the child inherits. Well, it doesn't matter whether the parents lived in this house or didn't pay or live in the house. The kids, they're going to keep that low assessed value, and they're going to pay the low property tax. It goes up for inflation, that $50 per year every single year. But I mean, it's generally a pretty good deal. That's going to be their only shot to own a property like that and pay very little in property tax. Now, after February 15th, this is what happens. The kid's just going to get reassessed. Now, assuming the parent didn't live in the house, the kid is just reassessed. You cannot pass on a non-residence and not get reassessed. But if for some reason the parent did live there, it's their principal residence. If the kid wants to live there properly indefinitely, they will keep the low property tax on this particular house. But if they don't live there, they will still be reassessed. And you can see here the property taxes, they're going to go from $2,500 a year to $8,750 a year. And they're going to increase $175 every year thereafter. And that's like rent if you really divide that. So,
Yeah,
go ahead, Jim.
Yeah. So if we do the numbers and we take those two numbers and they increase 2% a year over a 30-year period, the family pays $253,000 more in taxes. And we are under, at least now, currently a SALT cap, which is the state and local tax cap of $10,000 per year. So if the child itemizes their deduction, this is a big tax savings because you're saving after-tax dollars. So a very, very important tax benefit, Prop 13. So action items, if this is of interest to you, if you're like, wow, we've got a vacation home or a cabin or rental properties, or, mom's got a trust administration going on, seek advice ASAP. It is possible that you have to rewrite your estate plan to preserve your double parent to child exemption. That $1 million exemption, you may have to do the planning very carefully to pick up that double exemption. That $1 million per spouse exemption we talked about. So go to Cunningham Legal and set up a time to meet with us. The bottom line is you need to find an expert advisor, seek advice, and please follow it. So our job, we've been counselors more lately than advocates, certainly. And Greg asks, on the $1 million of assessed value that can only be passed to children without assessment, is that only $1 million of primary residence, or is that $1 million of other assessed value? So your primary residence of any value can be transferred plus $1 million assessed value per spouse. But this is, again, something you're not just going to want to say, hey, I'm just, I'm a DIY guy. I changed the oil in my car. I'm going to go do this on my own. There's a lot of gotchas here. So, okay. Anonymous asked, 5 kids and 5 rentals. Would the parent exclusion be $200,000 for each child if the properties are transferred prior to February 2021, in effect a savings of about $2,000 per year? So the parent to child exclusion is $1 million per person. If you have 5 children, it is $200,000 per person. However, this is a claim like a gold claim. It literally is the first kid that races to the assessor's office and files their claim gets it. So
you have to be coordinated, otherwise.
So it sort of can be a mad dash. So why does it make sense to gift a vacation home to children before February 16? And the answer, Connor?
Less concern about the capital gains.
Yeah. So what we're going to talk about here is capital gains. Capital gains is if you buy something for $1 and sell it for $3, your profit is $2. When you sell that thing for $3, you have to pay tax on your $2 profit. That $2 profit is your capital gain. And the $1 here is the basis. It's your purchase price. Certainly you can add in improvements. You can minus out depreciation. For many of our clients, though, the family vacation home has never been rented. I mean, sometimes it's rented, but generally it's not rented. Generally, people are going to keep this property after the parents pass away, and they're less concerned about capital gains taxes because they're frankly just not going to sell it. So this kind of leads me to kind of a fork in the road. If there's a decision tree, if your children are going to sell your property when you pass away, there's no need to do anything. If they say, Mom, Dad, we love that place in Carlsbad, but if we have to start paying for it, we'd rather just sell the property and split the proceeds. then you don't need to do this planning. Okay. Um, and that's a real question you need to ask your kids. And that's why, engaging with your kids, hey, is this something that you want to do? Certainly if you're a child looking at this on behalf of a parent, maybe an older parent, and you want to live in that property and don't want to be reassessed, then it's, that certainly is something where you would want to look at this and at least meet with us or meet with an expert lawyer, another expert lawyer on this topic to determine if you need to do anything or not. Really, how important is this to you? So the sales price minus your basis is your gain. If your sales price is $3 and your basis is $1, your taxable gain is $2. Now, generally in California, when somebody passes away owning property, even a married couple, when one spouse of the married couple passes away, the property generally gets what's called an adjusted cost basis. So provided it's community property, it does get an adjusted cost basis, meaning the surviving spouse can sell that thing for $3 and not pay any taxes. So that's adjusted cost basis at death. And then for business property, every year that a piece of real estate is held and rented out, the property is depreciated. So you don't depreciate land. For those of you who own real estate, you depreciate the structure, and then the basis is lowered. So you want to talk about the capital gains in the context of gifting?
Yeah.
Connor?
So just like Jim said, if you pass away or your spouse passes away and you're in California, you are going to get the step up, or the kids are going to get the step up. That means that the IRS, Franchise Tax Board, they're going to treat the person inheriting, the heir, like they purchased the property for fair market value at date of death. And so that's going to minimize the heir's gain if they sell, or if they're going to keep it and it's a commercial property or business property, they can depreciate from that new basis. Now, if you gift the home to your child, so you don't die, you gift it, then they take what's called a carryover basis. They take your basis. They don't get the step up. So like in Jim's example here, where he has the thing he bought for $1, now it's worth $3. If he dies, leaves it to his kid's going to have that product with a $3 basis. But if he gives it to the kid now, it's only $1. So if the kid sells for $3, he's going to pay the tax. Now, why does this matter? Because with vacation homes, a lot of the time people plan on keeping those homes because there's such an emotional attachment to it. I mean, I can't tell you how many clients we've all met with over the past month who say their best memories are in their vacation homes. They don't want to lose it. And so the kids are less likely to sell it. They have that emotional attachment and they're not going to depreciate at the same time. So let's go through an example. This is mirroring one of my clients. You have the dad and the grandfather who built a family cabin in Yosemite back in 1975. And the assessed value is $110,000. So they're paying nothing in property tax. And today it's worth $800,000. And the dad, he wants to keep that property in the family, and the whole family wants it in the family. The son and the daughter, they want to keep it forever. And if they make that transfer before February 15th, whether it be outright or through a trust, the taxes are going to stay at $2,000 a year. Now, on the other side of this, the reason why this makes sense for vacation homes is because the kids are going to take that basis of about $110,000. But it doesn't matter because the kids, they don't ever plan to sell the cabin, and they're not depreciating the cabin because they're not renting it out. So they really get all of the good of keeping that low property tax base, and they don't take any of the bad because they weren't going to do any of that part that leads to the bad anyway. So I guess we'll talk about what happens after February 15th, okay? And this is the big difference. So the dad and the grandpa, they built this house back in 75. It's still $110,000. All these facts stay the same. It's worth $800,000. Dad passes away after February 15th. Nothing's been done. Property's just reassessed. Taxes go from $2,000 a year to $11,000 per year. The kids still aren't able to depreciate from this new $800,000 basis because they're not renting out the property. They're just using it for a vacation home. So $2,000 a year over 30 years is $60,000 total. And $11,000 a year for 30 years is $330,000 in total.
And by the way, this doesn't even factor in the 2% increase per year. So that's, probably double that. So
yeah,
it's a big, if you guys have a family home and if this is important to you, if you don't care if you pay more in property taxes, another $9,000 a year, which it's rare that a client doesn't care about, just paying another $9,000 in property tax. If you don't care, then don't do anything. If you care, reach out to us, schedule an appointment. And what we can do is we're going through these issues with you to see if you should take the next step or not, right? So some people, after they meet with us, they go, you know what, for us, it's just not, it's not for us. They don't do anything, but at least they know, because there's this sort of artificial time clock. We have some questions here from Robin. We just bought a vacation home this year. Is there anything we need to do? Robin, stick around, because we're going to talk about LLCs and maybe it really, again, it depends on the context. Anonymous asked a two-part question. Can the transfer be done with when the one parent is passed and the surviving spouse is not well? Can the trustee with the power of attorney over the trust be able to transfer the main residence and rental income to use the $1 million exemption? Can the $1 million or $2 million exemption be used on multiple properties? We assessed the property when my father passed away 2 years ago. So there's a lot in there, and I kind of went through that quickly. When a person passes away, if you do nothing to preserve your $1 million gift tax or property tax exemption, it goes away. Yep. Right. Secondly is, you should probably schedule an appointment and talk to us, because if your mom is not doing well and she's going to pass away reasonably soon anyway, it might make sense to make some lifetime transfers. Then when I say transfer, that may not necessarily be a gift. It depends on the powers that you have in your trust and your power of attorney. And, it may have to be structured as a sale, not a gift, but we can certainly talk about that one-on-one. Is there a rental property? If there's a rental property, can the children still depreciate the property if they are gifted the property? Yes. When depreciation is taken on a rental, is it taken on fair market value or assessed value? It is taken on your basis. So typically your acquisition value plus improvements. And then said, I'll make an appointment with you. Great. So by the way, something you need to know with depreciation, you don't take it or leave it. Your property, if it's a rental property, is depreciated. The IRS depreciates it. So don't say, well, I'm not going to claim my depreciation. No. The property's, the IRS is depreciating it whether you claim it or not.
It's use it or lose it. That's what they call
it. Take it or lose it. So planning strategies before Prop 19 becomes effective February 16. Something you need to know, February 16th is a Tuesday, and February 16th is the day the new law becomes effective. February 15th is a court holiday. The offices of the county recorders are closed. And the Friday before that is a holiday. The recorder's offices are closed. So your effective date is really February 11th, not February 16th. This is a decision tree that a colleague of mine came up with. So this is how we go through the decision tree. The whole point of putting this up here is that there is a process that we go through. This is just we're not winging it. And there is a decision tree. And so, if you're watching the recording, you can pause and kind of look through this. I'm not going to go through it. But some very interesting planning. Now, this is, again, we're kind of in the middle of research and development, and this is real time for us. So I'm going to spend the rest of the afternoon going over the strategies that are available for our clients to preserve Prop 13 in the most tax efficient manner possible, not just property taxes, but also capital gains taxes and estate taxes or death taxes.
And let me tack on, Jim.
Yeah.
I think Jim's being a little bit humble when he says research and development. We have like 90% of this together. And a lot of our clients are like, okay, I'll take 90%. Jim's looking for the 100%. That's what he means by research and development, perfecting it. So don't let that deter you.
Yeah. And really, there's kind of a queuing process, or, it's kind of first come, first served. We have not picked a cutoff date, but there is a cutoff date that will be in advance of the February 16th date, because we absolutely have to serve the clients who have hired us to do work. So I would encourage you, if you're kind of on the fence on this, just set a time and get on our books, and then we can have that hour with you to figure out if you should do something. So can you just give away your real estate? This is. We're actually, some clients, that's our recommendation. If you're 89 and your spouse just died and you have an adjusted cost basis on your property and you're going into assisted living, it might make sense, right? Because cost basis isn't an issue. Typically an 89-year-old, I'm going to make a sweeping generalization, has a more stable family, but we'll just take that with a grain of salt. So simplicity, The pros are simplicity and lower legal fees. The cons, and this is a big one, loss of control. Okay, so there's a case that I'm aware of in Northern California where the son right now is seeking to evict the dad from dad's own house, and dad transferred the home to son. So, you know, that's probably in that case the client or the parent in that case is, you know, regretting transferring title to the son. Also, your basis carries over to the child. Now, again, for vacation homes, family homes, not as big of a deal. And then it's also subject to the client's divorce, which is a huge risk. And Connor, we see this in our practice. I don't want to say daily, but certainly weekly, where kids are getting divorced, and the parents are contacting us and saying, "Hey, well, you know, how does this affect the estate plan?" Lawsuits in bankruptcy, and also your child may die before you, may die out of order, and so the property could get reassessed. There are some workarounds using entities like an LLC, but you know, that's something to be mindful of. People do, as we call it, die out of order. And I see that every week, Connor. I don't know if you do, but meeting with clients. So what's the verdict on this one? It's unlikely to be appropriate in most situations, might be appropriate in some. And Carrie asks, how long do you have to sell a property before you get slammed with the taxes on it if there's no planning has been done? Typically, if you sell the property and you realize a capital gain, those taxes are due the following year. You may be subject to paying estimated taxes so that you fall in the safe harbor and you're not penalized for underpayment of taxes, but you typically have until the following year. California does have a withholding, an additional withholding that you need to be mindful of. Eugene asks, what are the implications of the proposition changes if the vacation property is in another state? Well, if it's in another state, it's whatever that other state's property tax system is. We're only talking about California real estate here. So there must be a better way. I think there is a better way, and we are naming this a Proposition 13 trust. It allows you to pass your Proposition 13 taxes to your children now, and it preserves Prop 13 for the lifetimes of your children. It is possible to structure it where the property is never reassessed, ever, okay? That does require essentially a continuing relationship with the lawyer and the client, but that is absolutely possible. You know, that's something that many of our clients never have the property reassessed. And you do that in combination with an LLC, and we'll cover that in a couple of slides. You need to deed the property to the trust before February 16th. So you cannot do it after February 16th. By the way, the assessor's office, Connor, we've been talking about this internally. They're backed up a month, 2 months, 3 months. So if you execute the deed, if you sign the deed and notarize it and deliver it to the trustee, that should be good enough. We are endeavoring to get all of these recorded before February 16th. And we use a service that physically walks them through or electronically files them. So there's some other alternatives. So the idea is you're the grantor, you're the creator of the trust. Your children are the beneficiaries, and a change in ownership occurs. So you want to trigger that change in ownership. Whether you can or should get an adjusted cost basis at death is case specific, okay? And there's really, Connor, you know, we talk about this. There is no one size fits all. Every one of these, and you know, a little bit of a little bit of full disclosure. We say every estate plan is unique, but let's face it, a lot of these estate plans, they do look similar. You know, one after, you know, okay, maybe the basic structure is the same. I've met with a lot of clients on this. Everyone's different. Like there is no basic structure on this at all. And so it's taking a lot more attorney involvement.
That's what Jim means when he says the R&D, where he says whether you can or should get an adjusted cost basis at death is case specific. I mean, we're trying to make it so everyone gets an adjusted cost basis at death, but that's what the R&D is.
Yeah. And these are all, you know, every case hinges on its facts. And I think more so with the Prop 13 trust. So Mark asks, good day. Thank you for the helpful webinars. Well, thanks, Mark. Mom passed away in March of 2017, the primary residence and rental home both under the parents' trust, but dad did not submit a death of owner when mom passed. 1, is dad still able to submit paperwork to gain the adjusted cost basis step up? And is the adjusted cost basis step up at fair market value as of March 2017? 2, if yes, then can dad file the paperwork and soon thereafter add me, his son, to the title, hence allowing me to preserve Prop 13 at dad's adjusted cost basis. Step up. Mark, make an appointment. You got a lot in there. This is what your situation is not uncommon. It is not uncommon for a parent to die and the other parent just says, I'm not doing anything, right? Whatever. No one's going to tell me what to do. All right. I get that. We see that a lot. It is not too late. That would be a forensic valuation. So it's very important that when a person passes away, property typically gets an adjusted cost basis. So it is really good. It's best practices to get an appraisal on the property. And so that gives you your new cost basis. In terms of him adding you to the deed, that may or may not work. And that's part of our R&D part. I will tell you, the transfer of ownership is covered by Revenue and Taxation Code, California Revenue and Taxation Code, section 60, 61, and 62. They're very dense. 60 is like 2 lines. But there is no easy way around this. And I'm not saying this to hide the ball. We're trying to be very transparent. There is no one easy way to do this because there are just too many factors. And you're dealing with, when you go on the Board of Equalization's website, they have something called annotations, which are derived from taxpayer letters. And so we're going in literally brick by brick, line by line, looking at these letters. And the problem is, on a very high level, the problem is, imagine you don't know what a duck looks like. And you go on the Board of Equalization's website and they go, here's a picture of an elephant. And I go, well, that's not a duck. Here's a picture of an alligator. Well, that's not a duck. There's no picture of a duck. And yet we're trying to figure out what a duck looks like. So this is not easy stuff. Joan says, I'm confused. I think a lot of people are. If I do nothing, will all of our properties except our primary residence get reassessed come 2/16/2021? No. Your properties will be reassessed when there's a change in ownership. Your death, if the properties go to someone other than your spouse, your death is a change in ownership. The property gets reassessed when you die. Okay, not now. You're not losing Prop 13. Can a Prop 13 trust be done by the trustee when one parent passed and the survivor trustor is ill? Maybe. Again, make an appointment. Perhaps. It depends. Can you refi in a Prop 13 trust, and can you sell property still and get the $250,000 Internal Revenue Code Section 121 benefit? That's one thing we're working on. I think that the short answer is we're hopeful. I think we can. The trust has to be what's called a grantor trust. The problem is the grantor trust rules. I think many of them are inconsistent with preserving Prop 13. So that's one thing we're working on.
And that one, you should make an appointment because we've had that issue come up several times. And there might be more facts there that lead to a yes.
There was a seminar a few weeks ago dealing more specifically with primary residences passing to children. Can I access that recording as well as this one afterward? Where can I find it? Go to our YouTube page, and we will be covering the primary home at the very end and the good stuff on Prop 19. William asks, primary home question. If I make a $500,000, if I make a $500 appointment, not a $500,000 appointment, sorry. If I make a $500 appointment to meet with you, will you be able to create a Prop 13 trust that will both allow my daughter to inherit my main home, not a vacation home, with a step and basis, and keep the property from being assessed even though she doesn't live in it? Is this possible? I believe so, and I think we're there. Here's the thing. I just want to make sure this is going to work. I don't want to do something where I'm like, it'll probably work. We don't work that way. So I think the short answer is yes. So go ahead and set up a time to meet with us. Marcy asks, can you explain the $1 million assessed value exemption? Is that per property? No, that is per taxpayer. That is per social security number. That is per person. That is per parent. Okay. So each parent has a social security number. The parent to child reassessment exclusion, the Prop 58 form, is a form that is completed by the taxpayer, typically the kids and the parent, right? They put all their numbers on there. The kids put their social security numbers on there. Mm-hmm. And then that form is submitted to the assessor's office, the local county assessor's office. The assessor's office, in turn, transfers that information to the Board of Equalization in Sacramento. They have a master index of all the counties and all the transfers by social security number. So if you think you can say like, well, I'm going to do $1 million in LA County and $1 million in Orange County, you can do that, but they're going to find out. It's kind of, we always get our man. I guess that's what they said in Dragnet. they're going to find out. You can't mess around with that.
Yeah, and I'm going to tack on, some of our clients have transferred property before and they've claimed this towards our $1 million exemption. If you're unsure how much you've given away, we can help you figure it out. We have access with the state.
Yeah, we basically fax them. We literally fax them a letter and they give us a response. So we have to go like find a fax machine. We do it digitally, but it's kind of funny. You fax the IRS and you fax the Board of Equalization. I think they're the last two agencies that use faxes. All right. Sometimes a completed gift is better. So for those of you who are wealthier, the estate exemption amount, the gift exemption amount, by the way, until very recently, the gift exemption amount was $1 million. I mean, Connor, when I started practicing, it was 600,000.
Mm-hmm.
No one would have in their wildest mind imagined $11.58 million gift tax exemption. That may go away. The Biden exemption, they're talking about a $3.5 million exemption and tinkering with change in basis when people pass away. And California may impose their own death tax. So this is why sometimes a completed gift is better. You do have to file a Form 709 gift tax return the April 15th following the year of the gift, unless you extend your return to October. You may owe gift tax, but with an $11.58 million exemption, completed gift, and then you are you're not paying tax, right? You just have to file the return. But go to Cunningham Legal, set up a time to make an appointment. Should you seek advice, and I mentioned this earlier, if you're going to keep the properties, vacation, rental, primary income properties, then gifting strategies should, and there's also a sales strategy in there that doesn't cause a capital gain. Those should really be considered. And I think it's worth it to say, you know what, I'm going to plunk down the money. I'm going to talk to these guys and see if in my situation, because we also quantify it, right? What is the value? And if there's value there, we'll make a recommendation one way or another, right? If there's no value there, if it's of limited value, then, then we're not going to recommend you do anything. So if your kids are going to sell your real estate after you pass away, preserving Prop 13, Connor, not that big of a deal, right? If they're going to sell it. But you need to seek expert advice. So if Prop 19 is so bad, how did it pass? Who was behind Prop 19?
Realtors.
Connor.
The realtors.
Right? That's right, the realtors. This is great for homeowners. Let me just tell you guys, if you're a homeowner, Prop 19, this is going to blow your mind. This is fantastic. Not so good for your kids, but really, really good for the homeowner. Here's the good stuff. And we'll have an example here that will put some meat on this bone. Prop 19 allows you to take your Prop 13 taxes with you to a new home 3 times in your life. Now, right now, the current law is if you're 55 or over, you get to take it once, and you have to buy a property of equal or lesser value. But Prop 19, effective April 1st of 2021, even if the property is more expensive, you get to take your Prop 13 tax base with you. So this is a really, really important, valuable property right. So you can buy a more expensive one. So to the extent that house is more expensive, that gets added to your tax base. And we don't know. The amendment to the Constitution says people over the age of 55, and we were kind of chuckling. Does that mean 55 in a day? Does it mean 55 in an hour? Or does it mean 56? The Constitution has been amended by this proposition. The legislature has to pass enabling legislation to sort out all these details. The legislature convenes in January. But you want to talk about this example? Connor?
Yeah, sure. And let me add on too. The old rules, you had to move to a house of equal or lesser value, either in the same county or you had to be on a list of participating counties, which was mostly Southern California based. Proposition 19, it's anybody. So if you live in Orange County and you want to move to Sacramento, you can now do so. All right, so let's go through an example here. Downsizing. So husband and wife, they buy a home in Pasadena in 1980 for $200,000, like a lot of my clients. And today it's worth $1.2 million. The husband and wife, they pay $5,000 a year in property tax. That's their assessed value plus inflation. And they want to sell the house in Pasadena and move to Roseville to be closer to their daughter. Now they sell their house worth 1.2 and they buy the house in Roseville worth 700,000. Well, instead of getting assessed or reassessed, whatever you want to call it, change of ownership on the Roseville house, they're going to take their Pasadena base year value, their assessed value, and pay on that up in Roseville. So it saves them $2,000 a year plus all that inflation. Okay. You have that second example, which is upgrading the home. And we have the exact same family. They bought the house in Pasadena for $200,000, and today it's worth $1.2 million. Husband and wife, they pay that $5,000 a year, but they want to leave Pasadena. They want to go to Carlsbad and maybe be a little bit closer to the ocean. So the way it works is that first 1.2 million out of the 3.2 million total is going to be taxed at the $5,000 per year. Okay, they keep that on the first 1.2. Now the next $2 million is taxed at the current rates of about $25,000 a year after all those fees. So before Proposition 19, had they moved and bought this house, this couple would have paid about $40,000 a year in tax. But with Proposition 19, this is the benefit of Proposition 19 here, they can move to a bigger house in a different county, and they can keep their low property tax base year value on how much their home has appreciated, the original home. So it encourages people to move. It helps people over the age of 55 move and not pay such a big bill.
Yeah, I mean, that's a great succinct example. So here's the deal. After after February 15 of 2021, the parent to child, we said that a parent can inherit a property of any value and not get reassessed. Going forward, a parent will be able to leave to a child if it is the parent's residence, meaning they check the homeowner's exemption box, the $7,000 deduction from their assessed value, and the child within a year claims that home as their residence, right? Clicking the homeowner's exemption box on the tax bill. If those two are true, literally the kid has to move into the parent's house, then the parent can leave to the child the Prop 13 taxes plus an additional $1 million in value. Everything above that is reassessed. This has gotten very complicated. I don't see in practice, we don't see a lot of people moving into their parents' house when somebody passes away. We do see the kids sometimes buy the house from the parents, but it's very uncommon for a child to move into a parent's house. So we've got some questions here. If we set up a Prop 13 trust, but use the Prop 19 leverage later to preserve Prop 13 residential home value upon the sale and repurchase. I know it kind of sounded, I understand the question, can you have it both ways? Can you use your Prop 13 trust and keep your Prop 19 ability to transfer your tax base? Probably not, because you have to own that home as your primary residence. The alternative would be to terminate the trust, but since you've already changed ownership to your kids, you're giving that up. And so that is why we're mentioning this, because Prop 19, for a lot of people, the family vacation home, it's kind of a no-brainer. When it comes to the home, they're like, I don't know about that. I may want to take my Prop 13 tax base, right? I will sell my house for $2 million and we'll replace it with a new house for $1 million. Assessed value is $700,000, selling for less. Can I keep my $700,000 assessed value? Yes, but this is something where you may want to talk to us about this, because if you do this before April 1st, it depends on if you're staying inside the county or moving between counties, and Prop 19 changes that. So Prop 13 is more restrictive. Quite frankly, Prop 19 is broader for homeowners. So there's a timing question on that. Jan asks, I sold my home in August and will be purchasing it in another area in California next year. Is it too late for me to take the property taxes for the house I just sold? It depends if your replacement property is in one of these. Is it 7 counties now, Connor? I know it was
mostly
8.
Southern California.
Mostly Southern California, and I believe Placer County, which is and San Mateo. Depends on the county you're moving to.
I mean, New York Times or LA Times did a piece just talking about how many people there are, just like Jan here, who were, in this process of selling, and now they can't do anything.
It's El Dorado County, Jan. El Dorado County voted like 3 years ago to take away the Prop 58. What's interesting though, is I wonder if Jan waited until after. I would have to read
I read that news article. It showed all the people who were closing right now just super angry because they're going to get reassessed, and they're like, I should have waited for this for April 1st. So there are people like you. Maybe type
Yeah.
it on Google.
So Lalit asks, Jim, do you know if both husband and wife need to be over 55 or just one? I believe it's just one. I just don't know. And again, the legislature is going to convene in January and then pass enabling legislation. So we'll have more answers. I mean, there will be an answer. We just don't have that answer now. So go to CunninghamLegal.com. There's a book your appointment button. I highly recommend that you, if you're concerned about this, seek out an expert. This is absolutely not a do-it-yourself project. And I can't tell you how many lawyers have watched our webinars and they're like, Jim, this is too complicated. I'm just going to send my clients to you. And we're happy to take those referrals. But even the estate planning attorneys who are expert lawyers are like, I just can't get my head around this. And that doesn't mean they're not smart people. It's just, it's taking a lot of time to figure this puzzle out. And really it's a puzzle. It's a knot that it just takes time to sort out. But I think there are solutions. They're not easy solutions. They are highly case specific. And really just think about this. Are you even in a position to give away your real estate, right? Because for some of you, it may mean actually giving it away. Are you financially secure? Will you need that money back? Are there mechanisms where you can get the money back? I think there are, but it's going to be more complex than you continuing to own the property. And then also, do you have estate or death tax issues? That's a whole other, that's a whole other kettle of fish, an extra layer of complexity. And again, go to CunninghamLegal.com to set up a time. Anonymous asks, can the $1 million exemption be applied over several properties or only one? It's over several properties. It's not just one. The $1 million exemption is per donor, so per parent, and on the parent's social security number. Connor, we generally advise against deeding deeding your property to your children without a solid plan. I mean, that can cause a real problem. Life estates won't work. What if you still need the income from the rental properties? That's a big deal. How do we deal with that?
Yeah, I mean, that's been a huge issue. We've had workarounds with it, but for some people, they don't want to deal with the workaround. They just want their income. And you should protect yourself in many cases over keeping your kids with the low property tax base.
Yeah, and I mean, we were working on a case with a client who's an apartment building in West Hollywood with an extremely low tax base, and they've got a multi-unit, multifamily, and they're under rent control. So if the property were reassessed, the taxes would go up. It was like 90 grand a year or something. It's just crazy amount of money, and it's almost to the point where because you're under rent control, those numbers just don't add up, and you're looking at selling the property. So again, highly case specific. So you really need to pay attention to your estate plan. And Connor, you've been meeting with clients on this. You want to talk about this, the need to revisit your estate plan if you start doing this planning?
Yeah, I mean, it's hard because we have meetings with people and people are just all over the place. Maybe just like the person on here talked about, maybe you're in a marriage and one of the spouses died within the last year or two or even 3 years. That means your basis is high and you might be in a great position to give to your kids because they'll get your high basis and they'll keep your same property tax. So we get people like that. And then we get people who at the same time, they have a commercial property that they like that depreciation. That's their main source of income and it doesn't make sense. So it's really hard to just look at these single sentences and tell you, oh yeah, do it or don't do it. That's why we do these 1-hour appointments where we look at your assets, we look at your kids, we try to figure out if the kids are going to keep things, where your basis is, and then we can make a recommendation. And it's up to you to determine.
And Denise asks, does the step up apply to more than the $1 million or $2 million property tax exemption you inherit that might be income property? Yes, those are two separate taxes. The $1 million exemption we're talking about is a property tax exemption. Adjusted cost basis is capital gains. So there are tons of different kinds of taxes. Like, the government's really creative in coming up with different ways to tax stuff. Marcy asks, hey, what about LLCs? We're getting there.
Yep.
B trust, briefly, if you have a funded B trust. So this is if you're one parent, and I use the term parent loosely, loved one, step parent, whatever, but you get the point. Is if one of your parents has passed away, or your spouse has passed away, and you have a B trust, which is a bypass trust, a credit shelter trust, whatever it's called, and that has property in it, assets in it, when the surviving spouse passes away, so if dad dies and the apartment building goes in the B trust, when mom dies, that property likely will get reassessed when the kids inherit it because there is no more parent to child reassessment exclusion after February 16th. So many of our clients are terminating those B trusts and distributing the property to kids. What can you do after February 15th? Here's kind of a best practices. Consider purchasing real estate and not your residence, because I think putting a residence in an LLC is problematic. And reasonable minds can differ on this. But if an LLC buys the property, it may be that property never gets reassessed, okay? Because the entity transfer rules, at least current law, says that if your property original owner is an LLC, so you don't buy the property and then put it in an LLC, but if the LLC is the original owner, so long as control never changes hands or nobody gets more than 50%, that property is never reassessed. And so you form an LLC, you form a limited liability company, an LLC. The LLC buys the vacation home for $1 million. The LLC buys the home, not you. And maybe the LLC rents it out on a short-term basis here and there, and then the home appreciates to $3 million. You leave the LLC units to your 3 kids. Nobody gets control. It's a third, a third, a third. No one gets more than 50%. There's no change in ownership. Okay. And this is solid law. This is a very, tried and true. Rich people basically can structure it where their properties are never reassessed. And we'll talk about a different way of getting there. But I would say going forward, best practices, look at an LLC, and that LLC should be the original owner, but it has to be acquired by the LLC and not you. So the other one is you form an LLC. And this is where you have 1 kid. So the prior one is you have 3 kids. And this is the one where you have, let's say you have 1 kid. Well, if you leave the LLC units to 1 kid, the property is going to get reassessed because the kid owns more than 50%. So what do? Well, you leave 48% to the kid, 48% to the daughter-in-law, the daughter-in-law, if that'll work, and then 4% to the grandkids. That does not result in a reassessment. So that's a strategy using LLCs. So you can see that the value or the benefit of acquiring property in an LLC. There is a workaround where you capitalize and recapitalize LLCs over about a 3-year tax period, and you can avoid reassessment, but most people can't wait 3 years. But that's a very common strategy for people to do intra-family transfers.
And I just want to stress, Jim, because I can see the attendees and I can see some of my LLC clients on here.
Yeah.
That plan he just emphasized, the LLC has to acquire the property, not the original owners. So if you're original owner, then you have to do this series of LLCs over a certain number of years.
All right, what's the drop dead date to start and create a Prop 13 trust and property transfer before the 2/15 deadline? How many days to plan ahead to meet the 2/15 deadline? We're talking internally about a cutoff in kind of mid-January, realistically. Might we let some people squeak in? Maybe. We're also concerned that the time of year that we're in right now, this sort of November, December, January, is when many people pass away, frankly. And so we're also going to be scrambling for the people who've recently lost parents. We're also going to be dealing with those Prop 13, Prop 19 issues as well. So we need to maintain some capacity for those people as well. But so what do you do? If you say, hey, this is something I want to do, go to Cunningham Legal and we set up a Zoom. I prefer a Zoom consult because we do screen share. Collect all your recent property tax bills, get those to us, locate your current estate plan. Please get that to us before your meeting. We do look at these documents before the meeting, and then we can have an intelligent conversation with you. Again, the consultation fee is $500. At the end of the meeting, the goal is what, Connor? Should you take further action or not? That's like the whole point of the meeting. It's been said that purpose of a meeting is to determine if there should be another meeting, right? And that's kind of what we're talking about. And then obviously, if we do work, there are additional fees that do apply.
Let me tack on real quick, Jim, because I've done quite a few of these meetings. There are probably a few people on here whose plan might involve separate, as in multiple transactions. Mm-hmm. And if that's you should make an appointment ASAP, because we really should do those in separate years. Mm-hmm. So if there are separate transactions like some of my clients have, make an appointment. Now, if it's just one simple thing, whatever you want to call it, one transfer, that's a little bit different. January's there. But if you think there's going to be multiple transactions, make an appointment.
Mhm. All right, so we'll keep it open for this. Kind of brings us to the end of our time together. We'll keep it open for some questions, but I know this has been just on a personal note. This has actually been a really exciting time because I've seen a level of collegiality with lawyers, and especially leveraging Zoom, the Zoom platform. I've never seen this in 25 years of practice. So it's, I think it's a net positive for the clients. Lawyers are very open in sharing their information. So it's just been really kind of an exciting time to be a lawyer and figure out, a new solution to a new legal challenge. And frankly, the clock is ticking on this, right? I mean, we've got till mid-February, and we've got a cutoff that's not that far out, where we just simply can't take new matters. We'll just be. Anonymous says, anyway, a compliment. Thank you. So somebody said, thanks, we're a great resource. I appreciate that. Anyway, any closing thoughts, Connor?
No, that's pretty much it.
All right.
Vacation homes, no, the basis doesn't matter as much. So, I mean, we put our money where our mouth is. We have attorneys in this firm, that parents have vacation homes, and they're the ones who are thinking about it most.
That's right. That's right. All right, guys. Thanks very much. Have a great day.